taking your time out and joining us here on ET Now. And reports suggest that demand-supply mismatch has led to the recent surge in gold prices. But you help us understand, how is physical gold moving from London to US on account of arbitrage opportunity which has impacted gold prices? What really is happening and what's the outlook going forward?
Well, thank you. Yes, it's certainly been a really interesting development in the gold market in the past 3 months. It's not because of stronger consumer demand in the United States, and it's not because of investment and speculative demand from the United States. What this is about is traders in gold who are fearing the potential for tariffs to be introduced onto gold imports. And what that's led them to do is to shift more than 600 tons of gold into COMEX eligible depositories in case they need to deliver that gold against futures contracts. So this is very much gold traders positioning themselves just in case tariffs come in, rather than structural underlying demand for gold.
Understood. So those are some of the reasons, but help us understand, at the moment, are we experiencing any impact of tariff war that we have seen globally?
We've seen, as I say, the shift of gold from London to New York has been because of a concern or a fear about tariffs. Similarly, that's had an impact on the London market as well. So there's lots of gold in London, but in terms of availability of gold to use in the market right now on an immediate basis, that's been lacking somewhat, because a lot of the gold that is theoretically available to the market is stuck behind queues in the Bank of England. So the Bank of England hold lots of gold on behalf of commercial banks. That gold needs to come out of the Bank of England and be used in the market, and that's just taking a bit of time.
Inventory situation in COMEX, how has it changed over the last 1 or 2 months because of the latest developments?
Well, the COMEX premium over London, because of US interest rates and because of the time to delivery, should be, I guess, about $10. And because of these concerns about tariffs, that premium has increased to as much as $70. That's one of the factors that's been pulling gold from London into the United States. But the premium has now returned to more or less where it should be. And similarly, the signs of shortages of gold in London have diminished quite a bit as well. So everything I can see in the gold market suggests that it's navigated this tariff fear very well. And we're now back to where we should be, more or less. It's probably going to get more interesting in silver, however, because it takes longer to move silver around. It typically travels on a ship, and because there aren't big central bank stores of silver in London. So what we've seen happening in gold is playing out in silver as well, but this might continue and could potentially get more extreme.
That was exactly my next question. How long do you expect this phenomena to last? Is it expected to be temporary in nature?
Yeah, good question. I think the gold that has gone to New York from London is probably going to stick around for 2025. There's probably enough gold in New York now for the traders to manage their positions based on the calculations that we've done. There may even be a bit too much, but most of that gold will stay there for this year. And I expect to see that premium in COMEX remain remain volatile, particularly during delivery periods from the futures market contracts. There is a possibility that we see a return to high premiums like we saw earlier this year. There's also the possibility that COMEX could trade at a discount. So I think people that are running positions between London, or between the OTC market and COMEX, are in for a pretty volatile ride this year. I would imagine that this uncertainty regarding tariffs will probably remain until we get clarity and expectations of stability from the tariff regime from the new US administration. And I'm not sure that people will become confident that they know what's going to happen there for quite some time to come.
So uncertainty is here to stay for some more time, led by tariffs that are being imposed by the United States. But John also wanted to understand, because of the flow that we are seeing from London to United States, is it likely to impact other markets as well, and that there could be shortage of gold in the other markets? Which markets could potentially be impacted because of this?
Well, I think every market which depends upon a large amount of imports has been affected by these flows of gold in the last few months, because the refineries that produce the bars that are eligible for delivery into the COMEX market are the same refineries that produce kilobars that go into the Indian market or the Chinese market, etc. So all the refineries that have been working full speed, 24 hours a day, producing kilobars to be shipped to the United States. So I would expect any importer, any country importing gold, say including India, China, Southeast Asia, will have paid more for the gold that they have got their hands on through higher premiums on kilobars, and may have experienced shortages. But I expect in the case of gold, though, these shortages should come to an end now, because we can see that the US market is calming down, and the London market, very high borrowing costs for gold in the last 2 months, that's now returning to normal as well. The good thing as well, from the market's perspective, is that high prices, together with the time of the year, have meant that the demand from some of these gold importing countries has been a bit lower. So Chinese demand is okay, but it's not super strong. If it had been super strong, we'd have really had a problem with shortages of gold. But as it is, I think the market's navigated this tariff worry very well. And if there are any shortages around, they will probably be fixed within the next few weeks.
Are expected to be fixed within the next few weeks. That's the word coming in, and that's as far as the latest developments are concerned with respect to demand supply mismatch. But look at the kind of run that we have seen for gold and silver. After the stellar 25% up move in calendar year 2024, gold is up another 10% this year. Do you expect the triggers that led to the up move, including purchases by central banks globally and safe haven demand buying, to continue for the rest of this calendar year as well?
I think so. I think all the factors that have caused central banks to buy a lot of gold are likely to continue, and possibly more. And similarly, investors and people using gold to protect themselves against uncertainty have even more reason to do so now under the new Trump administration. We've seen a tremendous amount of radical policies mentioned and spoken about and signed into presidential decree within the first few months of Trump taking office. That's concerning markets generally. And when markets are concerned about what the United States is going to do, that's going to translate into demand for gold. People are uncertain. There is risk around. Those are conditions which benefits gold.
Your research suggests when it comes to silver, do you expect silver to outperform, especially because its industrial usage is much higher as compared to gold?
Yeah, we don't spend as much time looking at silver as gold, but I would say two things about it. First of all, in the short term, these tariff disruptions in silver will probably last longer than they have done in gold, simply because silver is a less liquid market with no central banks out there to lend into the market. So that's the first point. So expect volatility in the short term. In terms of silver outperforming gold, though, you probably need to see an improvement in the global economic strength. So you mentioned before, industrial metals are a bit weak at the moment. When industrial metals are a bit weak, it's probably showing that industrial demand for silver is a bit weak as well. For silver to outperform gold, you need gold buying to be positive, as it is, but you also need to see strong industrial metals as well. Because the way I think about silver, it's about half gold and about half copper in terms of its drivers. So if we see a strong gold price and a strong copper price, then I think silver could do really quite well.
Outlook when it comes to gold and silver prices and the demand supply mismatch. John, thank you so much for taking your time out and joining us here on ET Now and helping our viewers understand what's the situation when it comes to physical delivery of gold in the global market. Thanks so much for joining in. Moving on to an ET Now exclusive.